Hey traders, today is Thursday, December 11th, and I'm Michael Boutros, Senior Market Analyst with StoneX, here for a quick multi-time frame look at the euro dollar on the back of yesterday's FOMC interest rate decision. Some key takeaways from the SEP and the updated summary of economic projections. We saw the Fed increase their growth prospects for next year from 1.8% on GDP to 2.3%. Unemployment remained the same, while at the same time lowering those expectations for inflation from 2.6 to 2.4 on headline PCE, core coming in just a tick lower at 2.5%. The updated dot plot did show a vast distribution still amongst the committee members with regards to where the expectations are for rates heading into 2026. Now, the kind of curveball that was thrown at the markets was this announcement of Treasury bill purchases again so late, so quickly after the end of QT. Here we are with a QE light, if you want to call it, largely being described as a reserve management, whatever you want to call it. It shows that the Fed is still willing to step into the markets at any point. The big takeaway, or one of the big surprising things that stood out to me, was this comment from Powell that the jobs and employment labor market figures may be overstated by some 60,000 jobs per month. So that is to say, if we're getting a 40,000 clip on a monthly basis on average, that we're actually seeing a contraction of 20,000 jobs a month. That was kind of the linchpin that really started the dollar on a larger decline. Here's what the euro dollar looks like first with the weekly chart. You know, we've been talking about this critical support zone for the last couple of weeks, over a month now, 1504 into 1497. You're talking about the March 2020 high and the 2022 objective swing high. It was also the 786 retracement of that advance off the lows they made back in July. That held 3 consecutive weekly attempts. We saw the rebound start to gather pace into the open of December. The first resistance level we were looking for was 1678. That would have been 2 equal legs off the low. If this was just a corrective bounce, you would have expected to see that hold and the potential for reversal. Yesterday, we did get a breakout, and that level has been compromised at this point. It was a breakout of the weekly opening range. It was a breakout of the monthly opening range, and it does keep the near-term focus for a stretch higher in euro. The first major level of resistance from here comes in line with the October high day close and the 618 retracement of the decline off the highs. You're looking at 1730, 1746. You can see that breakout of that late October downtrend, which materialized right into the start of the month, has now taken shape within the confines of an ascending channel of that late November low. And the upper parallel further converges on that level over the next few days. Here's what it looks like on the 4-hour chart. So initial support now goes back to 1678. If euro dollar is heading higher on this stretch, losses should be limited to the weekly open, the November high day close, the HDC, that's 1633, 1640. That should hold support if the euro is going to stretch higher on this stretch. Next level up, 1730 into 1746. And then just a bit higher, looking at the 1618 extension of the advance, that's 1794. And the 2025 high day close pushes that into 118.13. So that's a sort of key region on a breakout for the next level up in euro. Again, key support, look at that channel support, converges on the November high day close and the weekly open. Losses below that level, which suggests that we were looking at a false break scenario or the potential for a larger pullback in euro. Subsequent support zones, you're looking at the December open and the objective December swing low. That's 1589 into 116 essentially. So the level that would need to be broken for the bears to reassume control is all the way down at the October swing lows, and that's 1542. That would take you back below that slope, and that would suggest potential resumption for that multi-month downtrend that we saw from late September. So the levels are pretty clear. The risk is still weighted to the upside near term. Look for a reaction into this zone if reached. From a trading standpoint, a good zone to reduce long exposure, start to raise protective stops, get a little bit more defensive. The risk for inflection rises on the long side as you head towards that 1730, 1746 level. Don't forget, heading into next week, we still have a lot of event risk on tap. We get the non-farm payroll figures, and we also get an update on inflation here in the United States. So keep some powder dry into the close of the week. Best of luck trading. As always, I'll keep you updated on X at MB Forex. Till then, we'll see you tomorrow. Cheers.